business reorganization. In chapter 7, here there are few topics: business expansion and financial growth, merger taken over. Also, we know in our previous question, if we see, there are a few maths regarding merger and acquisition, and the investment math, business fail, why business fail, liquidation, and capital restructuring scheme. So today we are going to discuss business expansion and financial growth, strategy and expansion, merger acquisition, that is going to taken over, and regulation of taken over, and we will solve few questions. So after today's study, we will understand the business expansion, business reorganization, restructuring, combination, readjustment, phase of business cycle, financial growth, method of growth, and a strategy of expansion, merger and acquisition. There are 5 types of merger, we know: horizontal market expansion merger, vertical merger, and difference between the merger and acquisition, and tactical taken over, regulation of taken over, a few solutions regarding merger, acquisition, and taken over. Business reorganization or business restructuring is a process. Business go through reorganization when they have financially travel, new owners or new staffs, new management, new board, or new setup. That type can be reorganized it and restructure, change when come. So reorganization is an attempt to extend the life of a company facing sometimes bankruptcy through a special arrangement and restructuring in order to minimize the possibility of past situation recurring. So restructuring is a firm or company, they can change their core activities. They can shift one industry to another industry, one country to another country, one product to another product. They can change their structure also this way, and combination of 2 or more organization, they combine this. Sometimes it's a merger, sometimes acquisition, this way. So readjustment of a company, debt and capital structure can be restructured. For example, if previous they 60-70% equity and 30% debt, they can shift their capital structure. They can change. Now can be 40 or 50% debt and 50% equity. This way can be readjustment. And corporate reorganization involve restructuring and the way of company works in an attempt to avoid sometimes a double taxation and improve the profitability, also to achieving the goal, mission, vision, value of the organization, to increase the company's efficiency. So if we see that here, sometimes corporate restructuring, different types of technique we have, sometimes expansion technique, some are disadvantage techniques, and some others. So if we see the expansion techniques, first number 1 is merger. We can merge one company with another and then make a big company. And we can take over, a big company can take over another small company, and sometimes we may go joint venture. Expansion technique, that's the bigger one. And de-investment, that means investment can call up. So here different types of way, by liquidation at the final stage, and other different types of technique going. For example, now private company can be go public, or public company can go to private again, and share repurchase. Though in our country we have no permission for share repurchase, the company cannot buy its own share for investment purpose. Our Companies Act has some restriction. And management buyout, reverse merger, equity, etc. is the other techniques for restructuring, corporate or business restructuring technique. So here, if we see the joint venture, so the joint venture is different types. The joint venture are typically the characterized 2 or more venture being beyond the contractual arrangement, which establish joint control, both. So we can say joint control arrangement establish joint control over the joint venture, such as arrangement ensured that no single venture is in position of the control of the activity. So there are different types of joint venture. We know there are, look here, project-based joint venture, sometimes vertical joint venture, sometimes horizontal joint venture, sometimes functional-based joint venture. That type of joint venture can be it's possible for increase the value addition of the company. Also can be the joint venture can be from between a domestic company within the country, and also can be foreign country, foreign entity also. And here, in order to flow of skill and knowledge both the way, from outside country to inside and inside to outside. Business expansion can be possible. First, we have to establish a business, and then business day by day can be developed through the good management, corporate governance, and etc. And that company grow, and that growth can be expanded. That means for achieving the goal of the organization. So business expansion is a business strategy in which growth is often by increasing the number of stores in which customer or buy a company's product or service. We know the business strategy in which growth is obtained by the increasing and different way based on the organizational structure and the industry in that the store in which customer can buy a company's product and service. Unlike relocation, business expansion entities open a new store or different physical location while still maintaining the current business location. But nowadays, as the COVID situation, the e-commerce, e-business is growing up in our country, not only in Bangladesh, over the worldwide. E-commerce and e-business is growing up. So it's also as an expansion of business strategy or business expansion. If you go for e-business, and we know the different types of e-business we have: business to business, B2B, and customer to business, business to customers, government to government, Z2G, C2C, B2B, etc. Different types of e-commerce or e-business are at this moment is moving up. So organization or any business can move to that type of e-business also. So here, a growing of business product and service offering, and sometimes the phase of the business cycle, we know there are business cycle and step. Every business have the sometimes is a peak hour, and also go for that downline also. So if we see here in the below side timeline and left side level of real output. So if company start and then sometimes they go for peak hour and then again down, again peak, this way. Here, one stage of time, company go for new expansion. Otherwise cannot survive, or market share may lose. So a business cycle, sometimes called a trade cycle or economic cycle, refers to a series of stages in the economy as expands and contracts. So we can say the business cycle, also we can say trade cycle, also we can say it the economic cycle, and constantly repeating, it is primarily measured in the raise of the fall with the phase of GDP of the country. And business cycle are universal to all nations that have capitalized economics also. So there are, we can say there, that business cycle are identified as having four distinct phases. This four phases here: peak, trough, construction, and expansion is the final one. So here, need the growth of our company, that's financial growth. So financial growth, that finance is a vital integration. We know finance is a vital ingredient in the economic growth. We know the change of the company's national earnings, revenue, etc. There's a financial growth is an increase in the value of an investment over time. This is the basic thing. So what is financial growth? Growth in an increase in the value of an investment over time. A growth company is most likely to reinvest its profit to build its business. For example, if company do not pay their dividend, that amount, if they reinvest, so the value of the company would be increased. So here also growth increase. If the company prospectus, however, the stock typically increase in the value. Sometimes share or stock and mutual fund and real estate may all be classified growth investment, but some stock or share and mutual fund emphasize growth more than other. So though we have no, our capital market is not acting as the perfect way, but we are hoping that our capital market would be a good capital market in our country, because our regulator, our government want a good capital market. Different types of product will come in our capital market. So method of growth, there are different method. Growth through acquisition. Company can make their growth through acquisition. Another come to existing business, and also with collaboration with other company, and sometimes it can be licensing intellectual property, sometimes establishing a business agreement with the other dealership or other company, pursuing new marketing route, new country, new venture, and sometimes join industry cooperative also, and public stock offering. Sometimes if that company go for public, is also can be value addition or can be expand, and sometimes this way. So growth, there are different types of growth. We know some growth are internal, some are external. So internal growth means when a firm grow without involving other business within the organization. And external growth, when that means business sometimes joined one company to another company. Sometimes it can be merger, can be taken over, can be acquisition. So within the merger, join together the two just similarly size, similar company, etc. And this merger take a new company. For example, we'll see it, company X plus company Y equal to difference company, that means XY Limited, and taken over company X, company Y. If company X big company, Y is a small company, taking the company Y company, so company X exists, company Y finish. So this way, when a business buys a smaller business, is taken over. An acquisition, when a business buys part of another business, is the acquisition. So growth is an integral phase of the business cycle, and there comes a time when every successful business owner has a decide to expand the business for based on aligning with their goal, mission, vision, and value addition of the organization. The business expansion offers opportunities and rewards as well as risks, and that means the return. If we take the big risks, the return will be high. So growth, and if we see the strategy of the expansion strategy, different types of some common growth strategy in the business include market penetration, market expansion, product expansion, diversification, and acquisition. This is the different types of strategy. So growth leading to an expansion in our business where customer part placing more order. This part of the business cycle is characterized by factors such as increasing consumer confidence, etc. Because main thing is that all company, they need a good distribution channel. Here, adaptive strategy is here, decline how the organization will adapt to change in the environment of competitive landscape. So because all company, for example, any manufacturing company and other, they have the product diversification and they need a good distribution channel, and they need to retain their customer. So company, they are service oriented or manufacturing, they require the customers. So need the customers diversification, customer retain customers for the long term. So this way, if company can make service through the good product or through good service, that they can retain their customer. And so we can say that the expansion that can be this way: diversification, corporate strategy decision, that is diversification, vertical integration, market development, through the product development, through the penetration. And sometimes de-investment that means investment can be recall, liquidation, harvesting, and sometimes outsourcing. So this way can company adopt a strategy, different types of strategy we have. So if we see a good strategy of our business during this part of cycle is to build a business strength and reduce weakness. That means if we see a good strategy, that one, they align with the business. So strategy sometimes defines types of strategy. That can be innovation, sometimes international expansion, sometimes cost leadership, diversification, and different method we have. Sometimes internal growth, it's called also organic growth, organic within the organization, internal growth, sometimes taken over or merger. And different method, another method is joint venture or strategic alliance. So that type some strategy, and using different method, organization align with their goal and mission vision, then taking that strategy, organization can survive or go for taking huge market share, or can be expansion in different way. Merger and acquisition is another technique. So here we know a merger means a combination of two companies to form a new company. So look here, if we see below one, merger, here if we see company X and another company Y. But now if merge, it make a big company, just entity of company X, entity of company Y vanish. New company here, XY Limited. But acquisition is the purchase of one company by another in which no new company is found. For example, upper one, yellow color is a company. She's taking another company, but just existing is, for example, if a company A and company B, here is company A Limited. A Limited, B Limited equal to A Limited. It is the acquisition. B Limited is no existence now after acquisition. So here we can say a merger means combination of two companies. Why is it disturbing? Two companies to form a new company, while an acquisition is the purchase of one company by another in which no new company is found. Okay, so merger we have seen here is acquisition, and there are different types of acquisition we have. Look here acquisition, for example, it's a process also acquisition. Firstly, explanation, that means taking the disclosure, that means a negotiation, taking the due diligence, and different types of stages we have. So a merger is an agreement that unit two existing company into a new company. There are several types of merger. Also several reasons why companies complete merger. Merger and acquisition are commonly done to expand a company's reach, expand into new segment, or gain market share. We want to survive within the industry, we have to take different types of strategy. So merger also is a strategy for taking the market share, gaining the market share. And what are merger and acquisition? We know it. So there are different types of merger. Sometimes it's called horizontal merger, sometimes vertical merger, sometimes different steps. So what is horizontal merger? Horizontal merger, a merger between companies with similar products. And vertical merger, the consolidate the supply line of a product. For example, if any garments company want to merge another company who is making the hanger and other accessories, so that product required for the garments, but they merge with the company, is the vertical merger. And also if difference, we can make it different way. So that type of merger is happening. So there are different types of advantage in merger. If we merge one company to another, so is the sometimes we get the tax benefit, sometimes the cost, that means we may keep our cost less. For example, two companies, two MD, two CFO, two company secretary, two head of internal audit. If go for one company, so one MD, one CFO, one company secretary, one head of internal audit vanish. They cease from their job. So that expense can be here. That means less expense. Also sometimes some synergy also here. So for example, two IT platform of two companies, it's come for one platform. So all thing using here, that means the vacuum server, other thing, all can be used through the other people. So that type of benefit can come here, and financial resource can utilize and enter global market, and growth and expansion increase, help to face competition, increase the market share, and increase the goodwill also. Research and development can be increased, and different types of advantage in merger size. So 5 merger, we can say conglomerate merger, a merger between firms that are involved totally unrelated business activity. One is, for example, one is the company of capital market, another for the manufacturing organization. They can merge, but this merger is collaborative merger. So here, horizontal merger is a merger occurred between companies that same industry, horizontal merger. And market extension merger. A market extension merger takes place between two companies that deals with the same product but a separate market. Same product but separate market is the market extension merger. Another product extension merger is a product extension merger takes place between two business organizations that deal a product that are related to each other and operate in the same market. And vertical merger means merger between two companies producing different goods or service for one specific finished product. For example, raw cotton and then fabrics. So it can be merged. It's a vertical merger. So if you see the difference between merger and acquisition, sometimes that type of short note may come in our exam. Describe the difference between merger and acquisition. So here we can say that merger is two organizations is in one. It is the mutual decision, both company, and merger is expensive, then acquisition is the serious expensive, and through merger shareholder can increase their net worth. It is a time consuming, and company has to maintain so much legal issue also. And also acquisition is the buying one organization by another. It can be friendly taken over or hostile taken over. Acquisition is less expensive than merger. Buyers cannot raise their enough capital. It is faster than easier transaction. So it's the different types of So practice in taken over. So if we see here, taken over means a company taking over management of another company. It is a form of acquisition of a company rather than a merger. So taken over types is friendly, hostile, etc. So here, and if we see here, business takeover is a purchase of one company to another. The terms of refers acquisition of a public company whose share are listed in the stock exchange is corrected the acquisition private company. And sometimes you can take over a company for the buying the share from the market. So here, friendly taken over, hostile taken over, backfill separate, reverse taken over, etc. Main motive of taken over, strategic motive. Strategic motives means focused on improving and developing the business, closing link to competitive advantages, and financial motives is that focus on making best use of financial resource for shareholders, concerned with improved financial performance. For example, if you merge with another company, so company X, here EPS is for example 4 taka, and also company Y is EPS earning per share is 5 taka. So if merge, now EPS is 9 plus or minus. So because EPS grown up, so how this way and different steps. So that type of question also sometimes in CS come in our exam. So here the managerial motive is focused on the self-interest of merger, not necessarily in the best interest of shareholder. Main motive of taken over is there. So if we say regulation of taken over, so and there are in USA there is some regulation also. US Securities and Exchange Commission have the regulation, but taken over is a situation in which the offer or alone together with person acting contact with him, achieving the taken over. And a taken over designation applied the following security share with that means that there are some legal issue also, and within the company, within shareholder also, and taken over a public company if you want. UK already have the code of it, UK code. US already have. We have not that type of things, but the regulation of taken over listed company, India also have Securities Exchange Board of India, and the regulation is 2011 taken over regulation. But we have not that type of regulation, but already we have some companies are merging each other, taken over another company this way, but taking the permission from the regulator in different size, different perspective. So kind of taken over, legal contest and business contest. Legal contest, friendly or negotiable, and hostile. And business content, horizontal, vertical, and collaborative. So gains from merger or synergy. Look here. So what is synergy? The first steps of merger analysis to identify the economic gain from the merger. There are gains in the combination entity is more than the sum of the part. So here, combined value greater than value of acquired company plus standalone value of the target company. So combined value must be higher. The difference between the combination value of the sum of the value individual companies usually attributed by synergy. So value of the acquired plus target plus value of synergy equal to combined value. So here, look here. There is also a cost attitude of the acquisition. For example, value of company A, if 100, value of company is B, B is 50. So value of company AB now combined or merged 175. So how it's possible? Here 150, but value has come 175. So this 25 is synergy. So it premium is 10, net gain is 15. So here there are some problem here, unique problem. So here also solution is here. Look here. Company has agreed to acquire 100% ownership equity of a web company of 100 million. FMA has 35 million of liability outstanding. Determine the purchase price of target company. Very simple. Amount paid to acquire company 100 million. Outstanding liability 35. So total purchase price would be 135. So 100 million have to pay, and also 35 million is the liability. So liability should pay the acquire company. So the total purchase price would be 135 million. Key point, because this 35, that means 35 million have to pay the liability. So another one, look here. That type of question sometimes in your CS exam. Look here, merger and acquisition. Problem 72. So it's mean that we have discussed or complete you 71 question already we done. So now 72, all question is serially here. So E Company Limited is studying the possible acquisition of A Company Limited by way of merger. The following data are available in respect of the companies. Earnings after tax, E companies 2 lakh, F company 60,000. Number of equity share, that is ordinary share, 40,000, and F company 10,000. Market value per share, here taka 15, here taka 12. If the merge goes through the change of equity share, and the exchange ratio is based on the current market price, what are the new earning per share of E Company Limited? So if we see this one here, calculation of new EPS of E Company. So E Company is the acquired company. So number of equity share to be issued E Company for F Company Limited, because F Company have the earning is 60,000 and number of share 10,000, and here number of share 40,000, and market value per share is 12, here 15. So based on the market value, look here, 10,000 share of F company multiply by 12, market price 12, divided by 15. So it's 8,000 share should issue for acquiring F company by the E company. So here 8,000 share. Total number of share E company Limited after acquiring of F company, 40,000 existing, and new issue 8,000 share for acquiring 10,000 share based on the market price. So here total number of share now after merger 48,000. So total earning after tax, after acquisition, that means 2 lakh is here plus 60,000 and divided by 48,000 share. So here 2,60,000 divided by 48,000 equity share. So EPS is 5.42. So what would be the previous EPS? Here EPS is that. Here EPS, if we see, EPS is taka 6 and EPS taka 5, because 2 lakh divided by 40,000, 5 taka per EPS is taka 5, and here 60 divided by 10, so EPS is 6. But now combined EPS is 5.42. Number 1 is okay. Now if Company Limited wants to be sure that the merger will not diminishing the earning available to its shareholder. So look here, if company's EPS is now 6, taka 6, but she wants that EPS must be same, what would be the exchange ratio in this case? Look here, but now combined EPS is 5.42. Look here, calculate the exchange ratio. we should not diminishing the EPS of F Company Limited after its merger with E Company Limited. So current EPS is Taka 5 for the E Company and Taka 6 for the F Company, and exchange ratio would be that EPS. So 6 divided by 5, so exchange ratio would be 1.20. Number of new shares to be issued E Company for F Company. Now, previously they issue here, based on market price, they issue only 8,000 share for acquiring 10,000 share of F Company. But now, scenario change. Their exchange ratio is 1.20. So, for 1 share of F Limited can be purchased 1.2 share of E Limited. Now look here, 10,000 multiplied by 1.20. So 12,000 share must be issued for purchasing 10,000 share of F Limited based on EPS. So total number of share E Company after acquisition would be 52,000. Previously it was 48,000. So now EPS after merger 2,60,000 divided by 52, it is Taka 5. But the exchange rate based on market price, that was 5.42. So EPS changed because of increase the number of share, but weight of E Limited is the same. So total earning E Company now available for new shareholder, that means 12,000 multiplied by 60,000. Look here, for the 60,000, again here is 60,000. The shareholder of F Limited, they are no change any benefit. So it's one kind of question. Sometimes that question may come. If we see here, another one is also taken over. So look here, given the following information, is it taken over math 73, and answer also is here. Delimited, unlimited is a very simple, and it is the working. This math is in your exam January 18, debt and financial risks, came that type of math. What would the marks look here? 8, 4, 4, 4, 12 marks. So here it is the answer also here. With this math, solution is here. Here using the probability 0.2, 0.6, 0.2. We know the probability. Look here, just sell 2 lakh, its probability is 0.2. If sell, that is 3 lakh, probability 0.6. So this is the probability with the sale, and this calculation is here. This is the first line is probability, and based on that all calculation here, EPS this way. And the second part, third part, another math. Look here, capital structure from the chapter of designing capital structure. Is also can within that we can set it from this chapter also. So here 20 marks is also your question number 2 in January 18, and that was question number 4 January 18. Look here, so this math is the capital structure. A, B are the theory, that means 5, 5, 10 is the theory and 10 is the math. So this 10 solution is here. Look here, is this answer taken from a book, just as same as the book. So that book maybe M.I. Pandey or Khamjain, etc. Just state that math is here. The solution is here, this one. Just only changes rupee to taka, nothing else. Okay. So look here, designing capital structure is the math. Another one, this is not already come, but I will just discuss. Though that math is already in our exam. So that math cannot become, but that type of math can come here. So look here, it's a big one also. Construction. Following is the balance sheet of a company. Here liability left side, right side also, though is a T form, but now is the here vertical form. Asset, all thing here, equity share, preference share, debenture interest payable, loan from bank, trade creditors. Here land and the profit and loss total 1,400 is the lakh. So the XYZ company did not perform well and has suffered sizable losses during the last few years. How we can see that? Profit and loss account within the balance asset side, because it is the loss. That if here, that means the liability side, that is the profit. So few years. However, it is now felt that the company can be nursed back to health by proper financial restructuring, and consequently the following scheme of reconstruction. This is the condition. Trade creditors have agreed to forego 25% of their existing claim. So creditors, they only need 75% of their claim. They forego 25%. So it is thus a positive thing. For the balance sum, they have agreed to convert their claim into equity share of Taka 25 is. To look here, they are now they are going for the equity shareholder, not the creditors, and forgo 25%. So our equity share is 100 Taka each. So here said that equity share of 25 Taka each. Look here. So equity share are to be reduced 25% per share, fully paid up. So here equity share is 100 Taka. Now it convert into 25 Taka. Preference share are to be reduced with coupon rate 10% to equity number of share of 50 each, fully paid up. So preference share also reduced. Debenture holder have agreed to forgo interest accrued to them. So debenture holders, what is the debenture? 13% debenture. So 13% debenture interest accrued is 26 lakh. So they forgo it, 26 lakh. Besides, they have agreed to accept new debenture carrying of coupon rate 9%. Previously it was 13%. While land and building is to be revalued to 50 lakh. Plant machinery written down value 104 lakh. Provision amount 5 lakh is to be made bad and doubtful. In order to make payment for bank loan, the argument of working capital, the company issue 6 lakh equity share at 25 Taka each. The interest sum of the required to pay it and application. The existing shareholder have agreed to subscribe to the new issue. You are required to show the impact of financial restructuring, reconstruction. Also, this math is from this chapter. Also, prepare the new balance sheet, assuming the scheme of reconstruction is implicated in later and split. That means we know the share split also. So here reconstruction, if we go for the calculation here benefit. How come benefit? Look here. Reconstruction of liability payable. If we go for note here, there is no use note. Benefit of liability payable, that means reduce of equity share capital. 6 lakh share multiply by 75% share, 4 lakh 50. How come? Here this one 6 lakh share is reduced. That means here said that equity share are to be reduced 25 per share, fully paid. And here trade creditors have agreed to forgo 25% their existing claim for the balance above the agreed, convert their claim into equity share 25%. So in order to make payment, 25% is paid if the existing shareholder have agreed to subscribe to the new issue. So here the reduction of equity share capital, reduction 6 lakh share, now 75%, 450. Reduction of preference share 2 lakh, 50%, 1 lakh. Waiver of outstanding debenture interest 26 lakh. Waiver from trade creditors 300 lakh multiplied 25%, 75. So 651. And revaluation of asset, appreciation of land building, it was the 200 lakh, now 250 lakh, so 50. So 651 plus 50, 70 as in lakh is the benefit come from this restructuring. Amount of 701 lakh utilized to write off loss, facilities asset and overvalued asset. This 710 can be adjusted this way, write off profit and loss account. So here this one, profit and loss 485, this is the loss. So 485 here, adjust with that benefit 485. And cost of issue of debenture also within the balance sheet 5 lakh. Preliminary expenses have here, look here, this one, preliminary 10, cost of issue of debenture 5. This item adjust with that one. And also provision for the bad and doubtful as per the statement 5. And revaluation of plant machinery 196, that means revaluation plant machinery here, land building plant machinery 300, and here machinery how much revalued, while land building 250 lakh, plant machinery 140. Provision for amount 5 lakhs to be made for the bad and doubtful. Okay, so here 104 and 250. So here 104, here 3 lakh is come 196. So adjust with balancing figure 701. Now, what would be the balance sheet? Reconstruction balance sheet is that now 21 lakh equity share is 25, 525, 2 lakh 10% preference share 50 taka each, 100, 9% debenture 2 lakh, 825. Land building is come 250, plant machinery 104, furniture fitter 50, inventory as part the balance sheet 150. Sunday debtor 70 as per the balance sheet. Now adjust 5, bad debt, bad return of 5, so 65. And balancing figure make here bank balance 206. So this way can be reconstructed the balance sheet. So here said that opening balance of 130 lakh, sale procedure 150 lakh, payment bank loan 74, so 206 lakh. Here 206 lakh is this one, this is star, this is star. It's a balancing figure. It is worth mention that financial restructuring is unique in nature and the company specific, and vary to company, vary to industry, based on their size, based on their structure. It is carried out the practice when the shareholder is specific and understand that the restructured firm can now be nursed back in the health. These types of corporate restructuring help in the revival, that means survival of the company. So it is a one type of math, just for reviewing it. And if we see, here is another math, merger. Is answer also here.